Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, February 20th, 5:34 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in an uptrend since the O'Neill follow-through days on November 1st and 2nd, but you can see over here on the trend gauge, we've got a yellow sub-arrow listed under market leadership, as leaders sold off hard today. And reviewing the charts, over 20 leading stocks that I have on my approximately 120 stock leaders list broke below the 21-day moving average, and in some case below the 50-day moving average. That's enough to at least indicate some caution, some short-term weakness. And then after hours today, we had another leading stock blow up on earnings, further cementing our risk management rule to put in place to position size using 2 times the expected move on earnings, as Palo Alto is just being taken apart, and that's trickling over to other security software security stocks. As far as the 5 major indexes go, they still all continue to trend above their short-term 21-day moving average, medium-term 50-day moving average, long-term 200-day moving average. And intraday, the NASDAQ 100 undercut but reclaimed the 21-day moving average by the end of the day. We'll get into all this. But as far as the what just happened goes, as I said, leaders hit hard, but not a sell-off, more a rotation into defensive sectors, as staples were positive, utilities barely down, and a handful of sectors down between 0.2 and 0.3%. That's not an exit from the market. That's a rotation from recent leading tech stocks into more defensive, as we just hit. From a seasonality standpoint, the last 2 weeks of February are traditionally not to bullish in any way, shape, or form. So right on cue. The market sold off today. Here are the final numbers. Big 7 down 1.13%. RG8 is our 8 growth ETF composite, and we're ironically, today is the 3-year anniversary of a big sell-off in growth stocks. The day after President's Day 2021, that was the genesis for our creation of the RG8 as a way to track the overall health of some indexes that are tied to the growth names that are in the pond that we fish in. But the RG8 down 1.54% on the day. S&P 500 gap down 0.4, was down as much as 1%. Rallied, didn't even touch the 21-day moving average, and as I said, saw a bunch of rotation out of tech and into some more defensive sectors, down 0.6% on the day. Equal weighted, this is another reason we consider. I said in the heading of the email, is the glass half empty or half full? There are reasons for both, and probably ultimately NVIDIA will decide on its reaction on earnings tomorrow after the bell. But equal weighted, S&P 500 just down 0.23%, NASDAQ 100 down 0.75%, equal weighted down 0.5%, Dow just down 0.17%. And after hours, it was announced that Amazon will replace Walgreens in the Dow Jones 30. So certainly an upgrade from the quality of company, going from a $20-some stock that has basically no impact to Amazon, which is 160, up from 167 to 169 after hours. And as long as it doesn't sell off, obviously, will give the Dow a boost because it is a price weighted index. Mid caps down 0.7%. Russell 2000 was the laggard on the day, down 1.4. Global 60/40 down 0.13%. Bond prices up a bit, meaning yields down just a bit. In-house, our flagship portfolio, GROTECTION, down approximately 1.17% as leaders got hit. We're in leading stocks, but we're also heavy into the S&P 500 via leveraged ETFs. And this is the reason why, and this was again one of the lessons learned from that 2021 harsh sell-off in growth names, is that all the rotation, every time you sell out of growth, as long as it's not an exodus from the market, that's different. But if it's rotation, the S&P 500 catches all that. Being down 0.6% on the day is is nothing. It's a paper cut. Um, but when you see things like Nvidia down 4.5%, AMD down 4.7%, and a bunch of leaders also down 4, 5, 6%. This is why we keep that big ballast, that anchor in the S&P 500 of the portfolio, and then use leading names and healthy uptrends to augment the returns. But you can see closed in the upper third of the range, but below the 8-day exponential moving average, which is kind of flattened out now, but hasn't touched the 21-day moving average. I pointed out these levels, 49.18, 49.20, the lows of the prior 2 weeks. We didn't get anywhere near that today, still about 1% down to that level. But I'm going to keep the same time frame on, 30 minutes. I'm going to bring up the NASDAQ 100 because we pointed out this 425 level. And we undercut that twice during the day and recovered it twice during the day. So when we uncovered it the first time, we dropped below it the first time, we put a small partial hedge on SQQQ. When we broke it the second time, we put more of the hedge on. But as the day went along in the afternoon and we saw it was more rotation than sell-off, we regained that 425 level and started to come back on the S&P 500. We offset that with additional buys of SSO and buying it below where we sold it when we got extended over the past few weeks. So that's kind of the plan. Taking some profits when we're extended, buying some things back on the pullback doesn't always work, but if you don't book gains when you have them, the market will take them from you, plain and simple. And here's the NASDAQ 100 undercutting but reclaiming the 21-day moving average by the end of the day. That makes today's lows pretty critical. And you can see we're down 0.26% after hours, but I'm more concerned with that 425 or today's lows than the 21-day moving average right now, as long as the S&P 500 stays above the 21-day moving average. We use that as our short-term indicator. And also note on here the relative strength line. When the NASDAQ 100 made a higher high a week and a half ago, the relative strength line did not confirm that. Something we noticed, I'm not sure we talked about it in the video, but we did note the relative weakness in the NASDAQ 100 last week, mainly because Microsoft and Apple were exceptionally weak, but pretty clear relative weakness, not significant, but clear. Let's go to the Dow Jones Industrial Average. Just sitting on the 8-day EMA above the green line, the 21 EMA. Mid caps down 0.74%, sitting on the 8-day exponential moving average. IWM's all over the place, so is MDY. This isn't healthy action when you chop up, gap down, gap up like this, but still holding the 21-day moving average amongst all this chop over the last week and a half. Those are the major indexes. We'll go to the VIX. I got to pick the speed up here. We're over 15 over the 200-day moving average. This is not what we want to see from the VIX. We want to see it below both of those levels. The dollar, a little bit of benefit today. Normally for stocks, it helped out gold and gold stocks a little bit, but bounced at the 21-day moving average. The breakout not intact back into this recent base. We do not want to see us break back above this 104.50 area on the dollar, as that's a headwind for stocks. Okay, GLD, we'll look at GLD. GDX is still a mess. GLD rejected by the 50-day moving average. Bitcoin strong today. Closed at the top of the range, barely up though, but closing at the top of the range did show some strength. Now on to bonds, the broad bond index down 0.13%. The long bond TLT barely down, and really the impact on rates muted today. Not much of a move at all in the 10-year or the 30-year or the 5-year. Not a whole lot going on there with bonds. Note that they are above that recent breakout level, however, that they hit last week, and that's one of the Key things that we're focused on. All right, that's our inter-asset correlation. Let's get to the tail of the tape. You can pause this. I'm going to hit the highlights. Um, Day count, well, seasonality, I mentioned that, decidedly negative and right on cue. We are down on the day. Seasonality has been a fairly reliable indicator over the last maybe 6 months. Day count, second day down, first day below our ultra short term 8-day exponential moving average, 31 days above the 21-day moving average. As far as sectors go, ITB, XLP, XLU were the leaders on the downside, tech, XLK, SOX, and all the software. So some of the recent, when you come under pressure and growth stocks are selling off, you go right to your cost basis. You don't want to, and anything that recently came on board, blow it out. You can always buy it back if the landscape improves, but we had small starter positions in a couple things, and we just sold them for the 0.1% of AUM loss, which is where our stop is. That hit on Palantir, COHR, Datadog, AMD. With NVIDIA having earnings tomorrow, our risk management indicated we not only needed to reduce NVIDIA, which we'll do tomorrow, but we also were way over on semiconductors. So selling AMD as it broke the 21-day moving average, checked a couple of boxes. Uranium also broke the 50-day moving average. We're out of that. We put the hedge on the two moves below that 425 level, offset it with buys to SSO, and we saw strength come into the S&P 500. I'm going to show a couple of charts here and then a few in the portfolio, and then we'll wrap it up. Portfolio with the hedges, the sells, and the buys, adjusted beta reduced from 1.09 to 0.89. And the bottom line, leaders hit hard. Over 20 of them have broken the 21-day moving average, and we saw rotation today into defensive sectors. So let's start with what we sold. Palantir. Nothing wrong with it, just hit our stop. It was we got back into it after taking profits after the run up after its earnings move. So net, that was a winner. COHR, our stop hit on that. Datadog, kind of disappointed with this one. Our stop hit on this also. It's holding the 10-week and the 50-day, but below the 21-day. AMD sell off today. Semiconductors were weak today. Below the 21-day moving average. We locked in a 30-some% gain on this. Uranium breaking below the 10-week and the 50-day moving average. Took our stop was hit on that also. Let's look at the rest of the portfolio and what happened. So NVIDIA is still above the 21-day moving average. CrowdStrike's getting hit after hours because of Palo Alto down, 7.7%. We've got a little more than a 3% size on this, and some of that will trigger our stop tomorrow. Uber, still fine, down 2.3%. And Lilly, LLY, down today 3.4%, above average volume, but still above the 8-day exponential moving average. So a couple things, and this also gave us confidence on buying the SSO. Home Depot initially gapped down, but had a positive reversal and closed basically unchanged. GTC, this was we're not in it because it's on the thin side. It's not GTC, it's GCT. Giga Cloud Tech, some announcement came out today. I mean, down 25%. It was down 40% at one time. We'd stay away from thin stocks like this because without institutional support, this is the kind of stuff that happens to them. And then Palo Alto, a leader, down more than 2 times the expected move. The expected move was $33. It's down $74 after hours. They beat, but their guidance was bad, and nothing good is happening here. It initially gapped down to 310. I saw it bouncing up near 318 and now down at 292, more than minus 2R. And that's why we have our risk management rule to never lose more than 1% of assets under management on any earnings, any stock that goes into earnings. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, my partner Dan Stewart, Dan@RevereAsset.com. Our flagship portfolio is named GROTECTION because we grow assets when markets are in uptrends. We protect them when markets are in downtrends, like the 2022 bear market and the sell-off in late 2023 before we had the follow-through day on 2024 that in late 2023 that has led on this 20% plus run that we're on. And with that, I'll wrap it up for Tuesday, February 20th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.